then this number changes as well. So it's an ongoing, it's a dynamic process. It's not something that you can look at once in time. Okay, so the question then is, now that the tax credit has expired, what are the keys to long-term growth in the housing market? We have to look at the demand and the supply side. And from the demand side, the number one predictor is job creation. We've got to get job creation, and we've got to get more employment created nationwide and here in South Carolina. There are some good indications that that is turning around, and we'll get to that momentarily. But job creation is very important. Employment is the single best indicator that we have, the single best predictor that we have for housing demand nationwide and in South Carolina. So job growth is critically important. Because when you think about it, if you want to sell a house, if somebody's going to buy that house, they have to have a job first. If you don't have a job, it doesn't matter if they want to buy a house or not, they can't do it. So this is critically important. Secondly, interest rates. Interest rates have remained low for a long time. Eventually this is going to change. And the key then is, are we going to see greater amounts of job creation while interest rates are low? So the two working together are really going to boost the housing market. Secondly, we have to look at the supply side. First, we have to get some more easing credit restrictions on behalf of builders. I'm hearing reports, at least anecdotally, that a lot of builders have customers out there, but they're really, really struggling with these credit restrictions, so they can't actually go out and buy a house. They can't borrow the money to go out and build a house. So we have to get the credit market to loosen up a little bit. And secondly, existing inventories and foreclosures. This is still a problem, and again, we'll go into some specifics here in a moment. But inventory levels have to go down, and we have to deal with foreclosures as well. So these are the keys, and these statistics, these four numbers here, these four variables, are really what's going to drive the recovery in the coming months. So let's look at South Carolina. We already looked at U.S. housing starts. Let's look at South Carolina housing starts. So you can see this slow and steady growth that I'm talking about. This is what we want to get back to in the long run. Because in the 90s, we had a constant slow rate of growth. We didn't have these external shocks like we did with the housing bubble and then the subsequent housing bust. Another thing that's very important is confidence in the market. And I'm convinced that uncertainty, as much as anything, is going to drive the recovery as well. Because if you are concerned about whether you're going to have a job in 6 months, then again, you may be able to afford a house, but if you don't know if you're going to be employed, you're not going to buy that house. Okay? So when we look at starts, we're going to get slow and steady growth. We don't want to see these fluctuations in the market. That creates uncertainty and that creates problems. So let's take a closer look then at South Carolina here. And let's see if we're recovering and how the recovery rate is going. You can see here, this is the increase in housing starts since January 2009. Like I said earlier, we bottomed out in terms of housing starts in January of 2009. So it's important to get some perspective on how the economy has been recovering, how the housing market has been recovering since that date. And so what you can see, blue here represents 2009, and red represents 2010. And so you can see the size of the blue bar represents starts relative to January 2009. And so we can see that there's been some variability, of course. The late spring or the summer months have been very relatively high. But in general, we are recovering from that low, and that's very positive. In terms of sales, they're up 33, 20, and 18% in April, May, and June. If we look at housing starts by MSA, we can see some differences here. This actually tracks back from 2007 through the present what housing starts are looking like in different markets. We have Charleston, Columbia, Greenville, Spartanburg, and Myrtle Beach as well. And just to give you an idea of how far off we dropped, we had about 1,700 housing starts on a monthly rate in South Carolina in January of 2008. That was down to 751 in January of 2009. Back up to 1,710 on April 1st, and at about 1,100 at monthly rate current. So you can see, now if we look at the different MSAs, there's a difference there. You can see there are two lines clustered, Charleston and Columbia at the top, and then you've got Greenville, Spartanburg, and Myrtle Beach here on the bottom. That difference is actually about 12%. And so the question is, what's going on there? Why were Columbia and Charleston growing by 12% more than these other markets in 2009? What I want to do is look at housing starts at different MSAs in the state. So let's look at Columbia. slight increase. You can see the bubble. Everybody sees the bubble, right? And then the fallout after that. Let's look at Charleston. What's that? MSA is just Metropolitan Statistical Area. It's just the Greater Columbia area, basically. Okay, so the Greater Charleston area, again, the bubble here is a little more pronounced. So again, you can see the general trend of the 90s and then the bubble. Again, Myrtle Beach, same phenomenon. Sumter, it turns out, has had very stagnant levels of growth. Not a whole lot going on down there. There's some in-migration. There's a base, the Fort McPherson base in Atlanta is actually moving into the Sumter area. But this market has been relatively flat. And let's look at Greenville. Notice the difference there? What do you notice? There's a big bubble. They've been overdeveloped for quite some time, really since the late 90s. Now, they're struggling more so than the rest of the state in terms of the region, in terms of the MSA. They're struggling to recover. And part of it is due to this, but part of this overbuilt activity, or overbuilding, has to do with BMW coming in the late 90s. So there was a boom back then, and they overbuilt systematically after that, which hurt their market as well. All right, so what else can we look at to see how we're recovering since our bottom in January of 2009? And this graph didn't quite translate very well, did it? Okay. Well, what this is a way of defining housing starts relative to an average. Okay, so what I did here was to look at housing starts in these different markets before the housing boom. So from 2000 to 2003. So I took a monthly average in each one of these markets before the boom started, so that we can get a benchmark. This is what a normal market, what normal Charleston looks like, so to speak, what normal Columbia looks like. Then what we wanted to do is compare that activity, compare housing start activity today to what that normal is. So if you look at the blue bar here, you can see that's the bottom. That's the worst that each market ever got with respect to that average. So then if we look at Charleston, you can see that at the bottom, during January 2009, we're about 38% of the level of normal, which was in the early 2000s. All right, Greenville was far lower. So again, Greenville was doing very poorly, relatively speaking. But the size of that red block, and really the size of the whole bar, is where we are now. So the size of the red bar shows you the improvement that the market has made since January of 2009. One other to show you 2009 or 2008 to show you a complete year picture, since we don't have all of 2000, we're not through 2010 yet. But again, you can see the percentage decrease in sales. 2009 relative to 2008 here in Charleston, right around 5%. But again, Greenville was the worst of all the MSAs in the state. Okay. So the next question then is how are we adjusting? What's happening now? What's going to happen for the remainder of 2010? What should we know that's going to be important? First thing I want to talk to you about is the short-term consequences of the expiration of the tax credit. Now, what we essentially saw was a large boom in sales in March and April. The problem with that, though, is that because of the expiration, what the tax credit effectively did was to draw sales from the future. So we essentially borrowed future sales for a few months out into the present. So if we take this is a hypothetical graph. This doesn't represent actual data. We'll get to real figures here in a moment. But if you can think of 2010 monthly sales looking like this, increasing slightly over time as our market rebounds, but having very moderate levels of growth and being very even. This is what things may have looked like. Here's what things actually are looking like. Okay? So what we've effectively done is pull sales from the future from the next several months into the present. Okay? Does that make sense? Why that's the case? And so this doesn't reflect a long-term trend. It doesn't say that we're going to go back down. What it does say is that the market has to stabilize because we borrow these future sales. Now let's look at some specific data in Charleston. So this is Charleston sales activity. This is data that I actually got off the Trident, Charleston Trident Association of Realtors website. And so what you can see is pending sales here and closed sales. Now, do you notice any parallels between these two? Okay? Pending sales tend to predict closed sales. And that kind of makes intuitive sense, right? Because you have to put a contract on a house before it closes. So the more that goes in the pipe, the more comes out the pipe. The less that goes in the pipe, the less that comes out the pipe. Now, what happens then if we move pending sales is the